Hi there, welcome back to Stocks and Real Estate. Let's get right into it. With the recent run in the market over the past few years, it may be difficult determining which stocks we should be adding to our long-term portfolio. However, many established names are still trading at the lower side of their 52-week low and primed for a rebound. I'll show you the fundamentals and the charts so you can decide whether any of these five companies deserve a spot in your long-term portfolio. Remember, this is education, not financial advice. How I measure value. Checklist PE versus history, yeah, FCF yield, forward growth, technical setup, relative valuation, current PE or forward PE compared with each stock's own 3 to 5 year average, cash generation, free cash flow yield or dividend sustainability, moat and growth runway, ROIC, brand strength, secular tailwinds, technical posture, RSC, location versus 200-day MA, major support zones. Prepared to hold for a minimum of 10 years, unless price targets are hit prior. 1. Apple. Valuation reset. Bank of America noted that when Apple's PE dips below 25, the stock historically outperforms. It's now approximately 21 times forward earnings, down from 30 plus last year. Cash and buybacks. $29.9 billion operating cash flow last quarter, and an Altman Z of 9 plus keep those buybacks humming. Growth catalyst. Apple Intelligence. On-device AI, minimal capex, potentially higher services margin. Reuters. The 14-day RSI hit the mid-20s in early May, deeply oversold, and price sits near its 200-day moving average, a zone that's acted as support 3 times in 18 months. Investing.com. Takeaway. Rare chance to buy a 40+% ROIC company at a market multiple. Apple previous high is $260.1 is currently trading around $200. This name may take a long time to reach new highs again, but good thing we are looking for long-term names. I love a nice discount on a great company like Apple. 2. PepsiCo. Forward PE 16.1 times versus 5-year average 25.6 times dash a 35% discount to its own history. FCF yield 3.96%, the richest in a decade and well above the 5-year mean of 2.99%. Dividend machine, 52 consecutive annual hikes, payout ratio less than 75% of FCF, so the check is safe. Technical setup, RSI, approximately 31 and price 16%, under its 200-day MA, classic quality stock in the bargain bin. Story, snacks now drive greater than 55% of operating profit, an inflation-resistant segment that's still growing mid-single digits globally. If Pepsi can hold the 127.8 level, I would expect a nice recovery to the upside. We could easily see 140 and then 160. 3. Target. Cheap by any metric. PE 10.9 times, forward PE 10.6 times, half the S&P 500 and 35% below its 3-year norm. Income kicker, record 4.83% forward dividend yield with just approximately 50% of earnings being paid out. Balance sheet flex, debt to FCF 3.6. Buybacks trim the float again in 2024. Shares are approximately 28% below the 200-day moving average. RSI approximately 46. Neutral momentum right at a multi-month support band near $90 to $95. This name has been under a lot of selling pressure in recent years and has continued volatility due to temporary protests and scrutiny. This stock takes longer to regain its positive traction to the upside, but the discount in share price is undeniable and should not be overlooked. In 2022, Target was trading close to $260 and is currently at $92.2. I am keeping a close eye on this one for a change of character back to the upside. Why it can re-rate? Target aims to add $15 billion in sales over 5 years via store remodels and same-day digital fulfillment. Any execution wins could pull the multiple back toward peers in the mid-teens. 4. UPS Value Snapshot, PE 12.1 times, forward PE 10.9 times, cheaper than 86% of its logistics peers. Quality metrics, ROE 37%, profit margin 6.4%, Altman Z 3.1 to rare profitability solvency combo at this price. E-commerce secular tailwind, parcel volumes expected to grow 6 to 8% compound annual growth rate through 2028. UPS grabs premium yields from healthcare and small and medium business segments. Technical read, RSI is about 36, approaching oversold, with price 20% below the 200-day. Yet a short-term double bottom around $95 suggests downside may be limited. Bottom line, paying its 11 times earnings for a global duopoly player looks like classic value with a moat. UPS is currently trading at $96.6 and has a previous high around $234. If UPS can hold and maintain $88, be prepared for a solid rebound. 5. Nike. Multiple compression, PE 24 times versus 5-year average 32 times dash 25% discount to its own history. World-class economics, ROIC 18%, debt to FCF only 1.6. Brand still growing and profitable. Direct-to-consumer now 45% of revenue, lifting gross margin to 44.6%. Chart factors. Shares are 37% below their 52-week high and sit under every major moving average. RSI approximately 43. Historically zones where long-term buyers have been rewarded. Catalyst watch. Paris 2024 Olympics, summer 2025 fiscal Q1, often sparks a sales bump. Footwear innovation cycle hits shelves this fall. Nike is currently trading at $61.1 and has a previous high at about $180. Nike does have stiff competition from competitors, but I still see them succeeding in the long term due to strong management and track record. To recap, AAPL, PEP, TGT, UPS, and NKE all trade below their own historical valuations, generate a solid cash flow, and are showing technical signs of capitulation or base building. None are without risk, but history says buying quality at a discount and holding through the noise is how fortunes get made. Please hit subscribe so I can keep making these free videos. Which of these 5 is on your watch list? And let me know what topics to cover next.